Hello, everyone. Welcome back to another edition of Signal or Noise. This is episode 33. Charlie Bilello here. Peter Mallouk joining me. As always, Peter, a lot of fun topics we're going to discuss today. I'm going to jump right in here and run through the docket. Number one way Americans become millionaires. Hopefully you know the answer to that, but we'll dig through the data there. Number two, price controls and communism. Number three, taxing unrealized gains. There's proposals out there for that. Again, number four, 80 summers, a concept you tweeted out about. And we're going to end, as we always do, with signal or noise. We're seeing a record U.S. household allocation to stocks. We'll decipher whether that's a signal or noise. Okay, let's begin here with the number one way Americans become millionaires. And Peter, I love going through your replies every once in a while just to see your responses to these asinine tweets that people put out. And they put them out for good reason, right? They get a lot of attention. We've talked about the way you get attention on things like X is you put out outrageous things. Mm-hmm. And this person said, I've never met anyone who became financially independent by putting their money into a 401k. So why is it so highly encouraged? And you write back, I've seen more people become financially independent this way than any other way, not even a close second. So what's going on here? Why is someone putting that out, and why is it the case that people would be liking that and retweeting that and kind of agreeing with that concept when we know it's so patently false?
You know, I think this person might not have been doing it for attention. They might actually believe this. And I think a lot of this has to do with, like, who are you running with, right? It's possible this person has, 10 or 20 friends and none of them have become a millionaire in their 401k. And maybe this person's in their 30s. But the reality is, and this isn't even debatable, right? There's more Americans that are millionaires from their 401k than from anything else, not from being business owners, which is mythology, not from real estate, which is mythology. It's 401k investing, just taking a little part of your paycheck, putting it away every paycheck in your 401k, getting the match, keep investing over and over and over again. And you wake up in your late 40s or your early 50s, if you've been doing it since your 20s, and you're a millionaire. And even people who started later, they become a millionaire in their 60s. And that's the number one way Americans become millionaires. Systematic, disciplined, repeated, small chunk investing. But I think to know the people that have accomplished that, you have to be with people that are generally employed and, yes, have been doing it a long time, like 20 years plus, so in their 50s and older. But the data is kind of indisputable when it comes to the number one path to becoming a millionaire, and this is it.
Yeah, so I briefly just clicked on this person who wrote there, and of course, right away you can see they're trying to get people to invest in real estate.
Oh, I
operation,
see.
mobile
I didn't go that
so,
far. You actually
yeah.
clicked. Yeah, that's
it just had, incentives are driving something like this, and of course
right.
that you're trashing 401ks because you want people to instead take that money and invest it in your risky mobile home real estate venture. That's just, and maybe that will work out for some people, but to say that's a higher probability way to becoming a millionaire, certainly not. And if we look at the data here from Fidelity, very interesting here, an all-time high in terms of number of 401k millionaires, almost 500,000 in the US. That's stunning picture. And this is just at Fidelity.
Exactly. Fidelity's the leader in the 401k space, but you have Empower and Principal and 150 other record keepers. I mean, the number is at least double what we're seeing here.
Right. So how do you accomplish this? And we've did this in the 10 steps to a million episode, but I want to review it again. Very simple. Like, you don't need a high income. What you need is, like you said, consistency. You need to have a high savings rate. You need to take advantage of the employer match. So what I'm showing you here is an example. Someone starts out with a $50,000 salary. They get a 3% increase in that salary every year. They have a 10% savings rate, annualized return of 8% over 40 years. And they start investing when they're 25 and they retire at 65, and they get a 3% employer match, which is kind of the average. And you can see here, with that employer match over time, what that will grow to in that 40-year period, 2.4 million. That's assuming an 8% return We know that stocks have done better than that over the last 40 years, but just to be conservative there. And I think the difficulty with this, Peter, is what that person's promising with real estate or other people promise with risky investments is you'll get there tomorrow. You'll get there in a few years. And this seems such a long time to wait. Now we're talking about 2.4 million. Obviously, you would have reached the million mark before that point. But I think, of course, that's the hardest part. Like you have to all of a sudden you'll wake up and it'll be a big balance. But for years, it's going to seem like, what am I doing? I'm saving all this money. I could be spending it and I'm not getting anything for it. But over time, you just wake up and that compounding effect really takes hold.
Yeah, 100%. I mean, it just the thing about this is how much of this accumulates at the end. So in the beginning, when you're talking to somebody who's younger, which I do frequently, it can seem frustrating. Like, well, how am I ever going to get to a millionaire? But so much of this, I remember when you spoke about Warren Buffett and how much of his wealth was accumulated after he was, I think it was age 60. You
Yeah,
used, it's just,
98%. Yeah.
yeah, that incredible 98% of his wealth after age 60. It's the power of compounding, right? That doubling, you're using in this example 8%. So we're doubling, every 9 years. The majority of this is happening on the tail end, and when it kind of takes on a life of its own.
Right. So, what do you make of this? And we see headlines like this all the time. And this is a survey by CNBC, and 82% of people in that survey said it's harder to retire comfortably now than it was for their parents. And they're saying they may be right. Actually read the article, didn't provide any data as to why they might be right. Just kind of talked about a few anecdotes of people saying it's so hard with inflation and housing costs and other things. And these are real issues, certainly. But do you think that's the case? And the problem, I think, with things like this is you say it's too hard, and that was kind of the message in the article is, well, don't even try then because it's
Right.
so hard to save comfortably for retirement. But I'm not sure that's not even true in terms of today versus the people's parents' generation. If we're looking at someone 30 versus someone 50 or 60.
I think the difference is it requires. I think if you're a prepared, educated person doing the right things, it's easier today. But 90% of people don't meet that criteria, so it is harder. So I think like if you look at, a generation ago, you only need one person to make the money in the household and you could live comfortably. You put money away in your retirement plan. Inflation, with the exception of a very, significant spike in the 70s, generally contained, and you retired and your life expectancy was pretty low. You were going to get Social Security, you were going to live 5 or 6 more years, and that's it. Well, now households, you need two incomes to maintain the American lifestyle. You lose both of those incomes. When you get Social Security, your life expectancy is now 20 years. So the money needs to last a lot longer. And we have a bigger inflation problem. Maybe it's contained now, it's clearly decelerating. And you and I have talked about that.
Yeah.
But you have to be invested in a way to stay ahead of inflation, given the money supply and the national debt and all these things you and I talk about all the time. So I think like this having more time in retirement, losing the two incomes, having to be invested more in equities than maybe your parents were, and being knowledgeable about that to offset inflation. There's more pieces to the puzzle. There's more ways to have a problem today than there was back then, I think.
Yeah. And I think the forgotten part is that people today, if we look at millennials or Gen Z and any of these younger, like they spend more of their income
Right,
than prior
right,
generations, and that's okay, and that's kind of become more cultural. But if you went back, to the baby boomer generation when they were young, they simply didn't spend as much money as the younger generation is today. So part of it is just discipline. No one wants to hear that. Saving a higher percentage of your salary to put you in a place where you feel comfortable. And honestly, I don't know how someone who's 30 or 25 and they're starting out and saving is going to feel good about that when they're just starting out and they're
right.
hearing these stories about how difficult it is and their balance is very low and they're just starting. Like that lack of comfort, I think might be in part a good thing because it's going to force them to save a little bit more. Does that make any sense to you?
It does. Yeah, yeah.
Okay, so if you're thinking about your retirement, creative planning, we're always here to help with that and so much more. Reach out today for your free wealth path analysis. Go to creativeplanning.com/Charlie. With that, we're going to give you a free portfolio checkup, a retirement roadmap. Make sure you're on the right path. Make sure your savings rate is good, making sure you're taking advantage of everything you can. And we're going to give you proactive tax strategies to make sure that you're paying as little taxes as you should be, tax loss harvesting, efficient asset location, and more. So reach out today. We're in all 50 states. We likely have a location right near you. Over 300 billion in assets under management and advisement, and we're here to help. Okay, Peter, number 2, price controls and communism. I just saw your X. If anyone's not following Peter on X, he has awesome stuff. So get over there, follow him right now. 7 things every kid needs to hear. Number 1, I love you. Number 2, I'm proud of you. Number 3, I'm sorry. Number 4, I forgive you. Number 5, I'm listening. Number 6, communism has failed every time it was tried. Number 7, you got what it takes. I love that. Number 6
Right.
inserted in there.
Yeah.
Beautiful message that every kid should hear.
Yeah, every kid should hear it. I when I saw this the first time, I laughed so hard. But it is not a bad thing for a kid to know,
So you
especially yeah.
Yeah. So you would think that we, at this point, what we've learned in the last 100 years in terms of communism versus capitalism, you would think that we wouldn't be trying to emulate communism, especially in terms of economic policy. But lo and behold, here we go. We're talking about now perhaps a limit on prices at grocery stores, and we're talking about price gouging, and really they're laying the blame for high food prices at the feet of businesses. Corporate greed is why inflation and where it is, and this really hasn't been fleshed out in terms of detail, so there's not much here. But I guess the idea, Peter, is that during the pandemic and even today, I suppose, because they're still proposing it, grocery stores just woke up one morning and said, we're going to charge more for milk. We're going to charge more for
Yeah.
eggs. We're going to take advantage of the consumer, and there's not going to be any pushback or consequences. And we're going to do it all because we're greedy and we want more profits. What do you think of that conceptually? Conceptually, does that make sense to you?
Yeah, of course not. And let me just start by saying this, like, every time I write a newsletter or that has anything to do with any policy that a Republican or Democrat has, I always get, letters of what side of this stuff I'm on. My personal opinion is both parties are incredibly incompetent when it comes to economic policy. Maybe not incompetent. They know, I think they know how all of this all works, and they just are playing to their constituents. And I find them both parties to be very irresponsible with taxpayer wealth, and they just disagree on where to be irresponsible with the money, right? So that's my personal take on all of that. So let's
Sure.
just focus on this policy. So this policy is this idea that, like, hey, grocery stores, we see prices are up, and so of course people see, like, people are upset, right? Like, politicians see people are upset that their grocery prices have gone up. So of course the Republicans are not in power, so saying, look, your grocery prices have gone up, while the Democrats are in power, and the Democrats are saying, well, it's not our fault. Yeah, that they're up. It's not our fault. It's the fault of the grocery stores are just raising their prices and price gouging. Now, they know better. They know that's not how this works, right? Everybody wants to charge the most they can for their goods and services always. And the idea of competitive landscape is the market keeps you from doing that, right? If there's two grocery stores next to each other and one's selling apples for $4 and the other's selling it for $3, everyone's going to go to the grocery store that sells it for $3. Again, this is like, one of my majors was in economics, but this was like first week of the first class of economics, right? This isn't like advanced, this isn't a theory. This is how the economy works. So you can't just raise the prices. This can't happen. Now, if it does happen, when we see where it does happen, it's in an industry where there's only two businesses and they control everything and they're colluding in the background and say, hey, I'm going to raise, like, there are only two airlines and one says, I'm going to raise the rates and you go ahead and raise the rates and I won't lower my rates. And so we'll collude. Well, that's illegal and people go to jail for that. The grocery store industry is highly fragmented. The food industry is highly fragmented. There's thousands and thousands of producers. There's hundreds and hundreds of chains. This isn't happening here, right? The prices are higher because we put more money in the system We gave businesses bailouts and people stimulus and corporations and forgivable loans. We put all this money in the system and we lowered rates. And when you do those things, prices go up. More money chasing the same amount of goods, prices go up. And so that's what's happened here. And when you go talk about putting price controls in place, you're just diverting attention from the real issue, which is we've got to find a way to control inflation. Boy, that was a little bit of a rant. I didn't mean to go on about the whole thing,
No,
but it just absolutely, I'm incredulous at the policies coming out from both
well, I
sides
think
now.
right. I think you said it best. It's all just whatever argument will resonate with that base. And instead of taking responsibility, it's always easier to lay blame. This has become a political issue because Harris has proposed this. But if you go back, don't have to go back very long to see a Republican, Richard Nixon, early 1970s, did the same thing
Yeah.
with gas. And what happened? There were massive shortages. There were lines of people queuing up. So bad policy back then, bad policy again today. And it's pretty easy to disprove the notion that these companies are getting rich and they're fat and happy over this. If we look at Kroger, largest publicly traded standalone supermarket chain in the US, you look at their profit margins over time, you can see less than 2%. And we're looking at since 2020, it hasn't budged. It's
Yeah.
really essentially unchanged. If we compare this to your point in terms of like a monopolistic industry, you would be having a much higher you
Right.
compare it to the tech giants that we've talked about, where there certainly is some case to be made that they have monopolies, natural or otherwise. The profit margins there are so much higher than here. It's not even close.
Yeah. I mean, for perspective for our listeners that aren't like analyzing stocks all the time, it's one of the lowest profit margin industries that exists. I mean, it's
Yes.
not just low. It's like this
The average
very
S&P 500 company is a little bit above 10%. So
right.
we're talking about below 2%.
Mhm.
And if we look at Walmart, biggest supermarket, you can see same thing. Profit margin is actually down over time. If you read their earnings reports the last few times, they're talking about taking losses actually on their grocery
Right.
segment because they know the consumer is hurting and they're just trying to get them in the store. And that's been actually a successful strategy. But if we look at food price inflation, the weird thing, Peter, is this isn't really mentioned here. It's come back down, and it's come down to 1%. Hopefully, it stays down. And I'm not dismissing the huge increases that we saw. Certainly painful, but what were the reasons for that? Was it that these companies are trying to take as much from the consumer as possible, or is it because perhaps we were printing money and we were taking out trillions in national debt? And I'll show you the chart in that in a minute. But here are the negative effects that we've seen throughout history in terms of price controls. Number one, and this is not a small issue, it leads to shortages. So the idea that just out of the goodness of their hearts, these grocery stores are going to operate at a loss or break even, that's not going to be the case. So what do you think they're going to do? They're going to go out of business. There're going to be less grocery stores, and the ones in the lower income areas are actually going to be going out of business first. So you're going to have less groceries available for those people. Just a terrible thing, obviously. Then you get a reduction in quality and variety. So if you go to any communist country, obviously, Peter, you go to the shelves, you don't have 20 different types of chocolates to choose from. You have one chocolate to choose from. You could argue Americans have it too easy in that regard. We don't need so much choice, but more choice is better for the consumer. Of course, we know that. Then you have just obviously the lines. When you price a good below what its true value is, people are going to buy more of it. And that shortage of supply, you're going to waste all of this time waiting on lines. And that happened obviously in the 70s with the gas situation. You have a loss in gains from trade and you have a misallocation of resources. So far and away, the two primary causes of inflation are government spending and the printing of money. And so I would recommend anybody who's watching this to go read 40 Centuries of Wage and Price Controls, How to Not Fight Inflation. It literally goes back to the start of civilization, ancient Egypt, Mesopotamia. Like this was tried time and time again, Peter, and every time it's been tried, it's failed. And in the 1900s, we had obviously communist USSR disaster results from this. You have Mao in China trying to do the same thing, where tens of millions of people have perished because of those types of policies. And yet we're still talking about it today because it plays well. And this is why, if you go back in history, it always plays well with the average person who's
Yeah.
saying, yeah, we should control it. Why should we pay more? Why not say that eggs should only be $1? Why not limit that price?
Yeah. And it is just a misdirection of the villain. I mean, the villain is the printing press of the dollars and the things that the government is doing to create inflation. And by the way, this happened under Trump and Biden.
Sure.
Both of them, the deficit just rocketed. This is what creates inflation, not, not somebody selling eggs wanting to charge more. They always want to charge more. The market constrains them.
100%. And here's the chart, right? Neither one will acknowledge this, and neither will our Federal Reserve Chairman Jerome Powell, who's saying things. He's not using the price gouging argument, but he's not talking about the money supply. He's not talking about national debt. He's saying it was just the supply chains and commodity prices, spiked. No mention of a 40% increase in the money supply, 60% increase in national debt in a 5-year period. These are the primary causes of inflation. They will always be. Of course, you can have short term dislocations. No one's denying that during COVID. But the fact that prices didn't come back down after those supply chain disruptions eased shows you that it wasn't just that. Like, all this extra money in the system has to go somewhere. And it actually went into the economy and actually lifted prices. And the biggest reason why the inflation rate has come down over the past 2 years is, look at that money supply there. It's flatlined.
Yeah.
So they got the message, thankfully, even though they're not talking about it, they got the message. We can't keep printing money at this pace. And that's why inflation is moving lower. So hopefully they won't enact these types of disastrous policy. The good news, Peter, is I think the odds of this actually happening, which I think is true for a lot of the policies they're proposing right now. It's like every day there's a new giveaway or there's a new something that's appealing to a certain segment. But the odds in a divided government, which is most likely what we have, we probably won't have a clean sweep in November. The odds of any of these extreme policies on the left or the right pass, like, I just think it's thankfully very low, but not zero. So that's why we have to talk about it.
Yeah. Agreed.
Okay, let's move on to number 3. Another interesting issue here: taxing unrealized gains. This gets floated all the time, and here is the basic proposal here. I don't want to dig into too much of the detail, but the idea is, if you have an appreciation in terms of a stock that you own, a company that you own, real estate that you own, you bought it at 100, it's now 200. Well, should you be taxed on that difference before you sell that asset? And historically, as people know, no, we're not taxed on unrealized gains. We're taxed when that sale is made. But the proposal here is for people with more than 100 million in wealth. So I guess they're going to go around and try to value everyone's wealth to figure out who's in that group. But with more than 100 million, they're going to have a 25% tax on that. There's other details around it. You have to have a certain amount of liquidity, but the basic premise here is that the ultra wealthy in this country aren't paying their fair share. And I know we've already disproved that on this show, and I'll disprove it again in a minute. But they're not paying their fair share, and we need them to pay more in taxes. We don't have to do anything about spending. We need to pay more in taxes in order to solve the budget problems that we have, in order to do all of these ideas that we have in terms of additional spending. Where do you come down in terms of taxing unrealized gains in America?
Well, I obviously think it's a bad idea. I'll get into why, but let's start with just how these people are taxed, right? So we have a group here at Creative Planning that works with ultra affluent household, and there's a lot of people worth 100 million and up in that group, right? And that typical client has owned a business, or they have a concentrated stock position. They worked at NVIDIA or something like that, or they have a bunch of real estate, right? So generally, usually illiquid, meaning it's not just sitting around in cash. So they might have had a business and it was worth 10 million and they did really well and it's worth 130 million. And the government say, this proposal would say, hey, it's gone up in value. We want to tax even though you haven't sold. Now you got to remember, these people, they're paying income taxes and they're paying payroll taxes. And when they sell their business or their real estate or their Nvidia stock, they're going to pay the capital gains taxes. And I think the part that I think is the most missing here in these discussions is when they die, they're going to pay estate taxes. And that's in, say, California, New York, you're talking about more than 50% of your wealth that's left after you've paid property taxes and income taxes and capital gains taxes. The government will take on your death. And a lot of people go, well, there's a million ways for them to get out of it. That's not true, right? And my background as an estate and tax attorney, you can give it to charity. So if you look at Bill Gates' plan, Warren Buffett's plan, there's hundreds of people who have signed the Giving Pledge where they're saying, look, we're going to give 50% or more of our money to charity on our death. So Warren Buffett, it's 99%, I think he says, of his wealth is going to go to charity on his death. So he will not pay estate taxes because he's giving it to charity. But if you're not doing that or something similar to that, the government's going to take half your money when you're gone. So for people who are saying, well, look, they're going to accumulate all this wealth and because it's in their real estate, they're not paying as much income tax and we're never going to get the share from them. The government does get the share from them. At some point, that person's going to die. 100% of us are going to die, and the government will take over half of their money at that point. What's
But the
dangerous about
government doesn't want to wait. They want
right,
they want it today.
right. The issue with unrealized gains, I mean, I think it's obvious, but let's go through it. You've got this person, they buy a bunch of real estate, and their real estate goes up in value, and they've gone from 5 million to 10 million to 120 million. And the government says, okay, well, this year, because you're over 100 million, we want 25% of your gains. Well, to pay that tax, they'll have to sell their real estate, right? Or leverage their real estate. The guy with Nvidia stock will have to sell his Nvidia stock. Maybe he doesn't want to, or he'll have to borrow against it. And the business owner has probably got the biggest issue, right? So you're a doctor, you own a bunch of surgery centers, you owe $8 million of taxes. Now you're going to go sell a surgery center and pay the taxes, or every year you're going to leverage and then you're going to wake up and have all of this debt. The other issue is what happens when the business or real estate goes down in value. So let's say we have a 2008 crisis. Somebody's paid all these taxes on unrealized gains, and then in '08, the value of real estate goes down 50%. Is the government going to now pay you on your unrealized losses? And then lastly, most of this is illiquid, right? So how is the government going to know what anything is worth? If somebody owns 4 different businesses or oil and gas interests or mineral interests, every year, are we going to get a valuation? Who's going to do that valuation? How is the IRS going to qualify it? So we're going to create a whole valuation and accounting industry, and people are going to play games and gift shares to other people to diminish the value of their business. This is just not practical. So it has nothing to do with your politics. If whether you want there to be more taxes or less taxes, I get it on both sides. This just isn't the way to do it, right? There is a way to get more taxes from wealthy people. You could raise the capital gains tax. You could raise the income tax. You could raise the estate tax. All of these are going to disproportionately hit wealthier people without creating a sea of, bureaucracy and accounting and valuations and games that people will play. I just don't. It's not a practical solution.
That's certainly not, but I think that's part of the desire here. If they were able to implement it, think about how much more control the government would have, right, in terms of knowing everything about illiquid what type of team would you need to value this type of stuff every single year? As you said, government's not very competent in most things. The idea they're going to get that right. And what happens in this situation, and it's not uncommon, right? Especially with these startups. We saw it in 2021. A lot of these startups were valued at 20 billion. And then a year later, they're valued at $1 billion, right? They just had so that person's going to pay all of that tax. And there's nothing within this proposal to say they get a refund of that or anything. They're going to pay all of this tax. And now the company is worth so much less. What are you going to do in that situation? But the biggest thing, Peter, I think the biggest argument against it is really discouraging the long-term investment, risk-taking, entrepreneurship, the things that have made America really stand out versus the rest of the world are those things. Like you're taking for granted. You think that people, start these businesses and they're going to succeed and they're going to get to that $100 million point. No, that's a small percentage of people. And you don't want to discourage those people from achieving that level of success. So it really is a punitive thing in my mind where it's simply saying, well, that person has more than me and they shouldn't have more than me. And we should take some of that. We should take it now before we even know what they're going to end up with after all is said and done.
Yeah, I think the thing about capitalism is that really plays to politics is it creates dramatic outliers that is perceived as unfair, right? So let's take Taylor Swift, right? I took my daughter to every Taylor Swift concert she's ever had. I'm sure there was a day Taylor Swift was worth hundreds of thousands and then millions, and now she's one of the few artists to become a billionaire. And she played at Arrowhead in Kansas City, and I took my daughter and some people, and we went to this concert. And the message that you got economically in the background and the impact that Taylor Swift had on the city, but that Taylor Swift personally was making $10 to $14 million per show, which sounds about right, and
Yeah.
probably could have made more if she charged you more for tickets. But that means she made more per that show than everyone else involved in her show, than every single person working in the stadium, every single dancer, everyone in her band, everyone working concessions, all of security, all of her trucking crew, all of them put together made less on that show than she did. Or, I went to a movie, it had Scarlett Johansson in it. My wife and I went to see it. Not a great movie, this particular one, but she makes more in that movie than everybody else involved in the movie put together. Every other actor and actress, everybody on set, direct, everybody. And that seems unfair, right? But would anyone go see that movie if it wasn't Scarlett Johansson? Maybe not. She has a bigger impact. Can anyone else fill up Arrowhead besides Taylor Swift at that ticket price? The answer is no. No one else can do it, right? So they're outliers and they get disproportionately rewarded. And so it's interesting that it's easy to get a political thing and go, well, this is not fair, right? So you can agree or not agree that it's fair, but Taylor Swift is going to pay her taxes, right? Whether there's an unrealized capital gains tax on her catalog and everything else she's doing or not, someday she is going to, besides the income taxes and property taxes and capital gains taxes she'll pay anyway, she will pass away. And she's either going to have to give all that money to charity or the government is going to take half of it. So, I mean, I think
Yeah.
that if people can just understand that this works itself out in the long run. And the system may be unfair, but what's the better system? Is the better system to say the actress that brings everybody to the movie theater should not make more than everyone else?
Should
Yeah.
Taylor Swift
Should
make the same as
should
everyone else?
yeah,
And
should
on the,
yeah,
it's
should
that
she
communists might argue that that
yeah.
would be the right system, but then you wouldn't have the Taylor Swift to begin with. Most likely, you wouldn't have these entrepreneurs. And if the idea is that this risk taking, in part, is one of the reasons why we're the most prosperous nation in the world, then you're really taking a big risk by challenging. So if everyone's lifted up by capitalism, but it just so happens that the top is lifted up to such an extent that there's a huge disparity, to me, that's a better outcome than everyone being down but equal. Right.
That's
So
right.
that's
If
really the
it's not
comparison.
human, yeah. Unfortunately, human nature is comparative, right? But if you look at the United States, if you look at what's driven the global economy, Google, Facebook, Nvidia, Microsoft, all of these incredible companies, they're in America. Is it because there's just some brilliant gene that exists in America? That's not it, right? It's the system and it's the rewards that the system gives you. Now, what do we get in exchange? You get Elon Musk with his billions of dollars, and you get the founders of Google and Nvidia with their billions of dollars. And is it fair? I mean, I don't know, but it works in terms of lifting up the quality of life for everybody and driving the economy. And they will, in one way or another, pay their share of taxes along the way, or if not,
Yeah,
in
I
the end.
certainly think it's fairer than redistributing it, than
Right.
saying
I
like
mean,
this person was
yeah.
successful, so we're going to take that and give it to someone else,
Yeah.
and just
Capitalism,
for the
but
reason
yeah,
that
it's
we can.
capitalism's a terrible
Right?
system until
There,
you
if
compare
you
it to every other system, and then
right
then
there
it's
isn't
when it looks good.
equal risk taking, there isn't equal time people spend working, there isn't equal jobs. Just everything is different. So why should the outcomes
Yeah.
be exactly the same? They shouldn't be. Right?
Yeah.
Elon Musk should be rewarded more for the risk that he's taken than the companies that he has built. And I just want to put this to rest because this is really the underpinning, Peter, when they talk about this. It's always they're not paying their fair share. And if that were true, I'd be on board, not with the wealth tax, but certainly raising taxes so they are paying their fair share. But if we look at the top 1% of income earners, they make 26% of the country's income and they pay 46% of the taxes in this country. Their average tax rate is 26%. If we look at the bottom 50% of income earners, 10% of the income they make, they pay 2% of the total taxes. Their average tax rate is 3%. We talked about the last time 40 something percent pay no federal income tax at all.
Right. And every now and then someone, from the more conservative side will try to propose a flat tax. And I don't think that's reasonable either. I think the country's been really good to people who have done really well. And I like this chart because it makes it clear that they should be paying more. And they do.
And they look at the trend. I'm a flat taxer, but we won't have that debate today. But look at the trend over time, over the last 20 years. They're paying a higher percentage today than they
Yeah.
ever have. And so the idea that this is based on fairness is totally not the case if you just look at the data. Okay, we got two more topics to cover here. 80 summers, Peter, you put out this tweet. Awesome message here. The problem is you think you have time. On average, we get 80 summers if we're lucky. Don't put off the trip. Stop waiting for life to begin. Stay up late with friends. Get up early to watch the sunrise. Catch every sunset. Book the trip. Go on that hike. Go to the beach. Spend time with those you love. Tell them how you feel. Did you get the most out of your summer, Peter? Did you check some of these things off?
I am so conscious about all of this. I saw something maybe 15, years ago where somebody went through like how many more times, like he goes to the beach every year and like how many more times he had of that and how many more times he had of having pizza and how many more times he had with his siblings that didn't live in town. And it was
Yep.
the worst thing I ever read because all I could think about is that I'm constantly doing the math of like, because you always think that whatever you're doing, you're going to do it many, many times more. And you start doing that and you realize, wait a second, every single day is precious, right? And so I've constantly got this hourglass
I think there's a
with
clock. Maybe I'll get it for you as a gift
sand
where
going
it'll
through it in the
show
back of
like
my
your average number of minutes or hours you have until you're
right.
expected to die.
Yeah.
That would be a good reminder. But I know you and I both read this book. This is something we recommend. People are asking, "Well, when's the book segment going to come back?" We're bringing it back in part here, but next episode for sure, we're going to have some more book recommendations. But When Breath Becomes Air, Paul Kalanithi. And I read this book. I was 37 years old, same age he was when he died here as a surgeon. And he just gets news that he has cancer, and just a gut wrenching book. But I tried to reread it time and again, just as a reminder, because it's easy to look at these things. But I like that reminder that we don't know.
Yeah.
Everything is precious here. Get out and do and make the best of everything, because we don't know when it's going to end.
Yeah. Every day is a blessing.
And lastly, on that point, the last lecture, if you haven't seen it, Randy Pausch, he was a computer science professor at Carnegie Mellon. Worth your time to watch that. He also got a cancer diagnosis. I think he was in his 40s when he passed away. So get after it. Not just the summer. We're in the fall now. Many opportunities to live life to the fullest. All right, Peter, we got to do signal or noise here. And this is an interesting one. First, I think this is a great chart that kind of illustrates awesome thing to see from a U.S. standpoint. The fact that the share of our household financial assets that are in stocks in the U.S. compared to other countries, we're almost number one. Estonia, I don't know what's going on.
What is
There.
going? Yeah,
So
that's what I was like. What is happening in Estonia? I
so
mean,
I didn't research why that's the case, but good
there
for
has to
them.
be a story there. I mean, there has to
Yes.
be.
Maybe they get some big incentive to
Yeah.
invest in the equity market there, or something. They get some government match, but I will look into that for a future episode. But this was as of 22. We were approaching 40%, and JP Morgan just updated this over time, and you can see the chart here. We're at a record now, 42% of financial assets in stocks, highest ever, even higher than the dot-com bubble, which was under 40%. What do you make of this? So some people are looking at this chart. Obviously, in the early 1980s, when stocks were very cheap, this was low, it was 10%. We're above 40% today. Is this a reason to be nervous? And is it a signal or noise?
A total noise, and I think it's just part of it's the adoption of 401ks and moving away from pension plans, and part of it is the incredible multi-decade bull run. But I think it's a positive.
Okay. Yeah, I'm mixed. I don't think it's a signal by itself. I don't think there has to be a percentage, right, that where it's like a warning sign or not. I would just come back to valuations, and we've talked about this a lot this year in terms of US equity valuations. We're not on the cheaper end of things, we're on the more expensive end of things. We're 49% above the historical median if we're looking at price to peak earnings, and that doesn't mean anything for the next year, 2 years, 6 months, throw all that out. But 10 years forward, the odds of the next 10 being as good as the last 10 for US equities very low. And what should that mean for you, Peter? As we've talked about, make sure you're diversified. We know what's powered this. We know what's in terms of the multiples where the highest multiple companies are. They're all tech related, all AI related. So being diversified now more important than ever. But overall, this is obviously a good trend for people, good trend for the country. You want to see this. But just be mindful in terms of expectations that valuations are not very cheap. And that's because, like you said, we've had a strong bull market. So we'll end it right there. Covered a lot of ground, Peter. Fun topics today. And if you're watching this on YouTube, just take a quick moment, hit that subscribe button, hit that like button, leave a comment. I try to respond to as many comments as possible. I'm like Peter does on X. I try to do it on YouTube. So we have both of those platforms covered. And we'll see you next time on Signal or Noise.